Video good, everything's good. I'm a happy person. And now we can talk about the market. So anyway, these are the futures. These are not, this is not the actual NASDAQ, but the NASDAQ's probably over 16,000 now. It's about 50 points below where the futures are. And the futures, these futures contracts are for December 31st. So when you're looking at the futures, you're looking at where people think, the index is going to close on December 31st, not where it is at the moment. They aren't usually that far apart, but this is a sentiment. It's a quick take on sentiment. So sentiment at the moment is still bullish, and it almost always is bullish, but it's still bullish for all the indexes. People think we're going to be higher into the end of the year, but not much, just a little. That's fine. The dollar is weak at the moment. We saw that, and we talked about that this morning, and I'm going to get out of this because I'm not really interested in this stuff right now. Gold is pretty excited at 2066. Silver is almost at 25.68, coming in towards $26. So, a lot of the story is dollar weakness at the moment, and we'll look at that on the futures charts. So, if we go to a daily chart, look at the dollar. I mean, it's from 107 to 102.7. So that's what, like 4, need a calculator. So 4 divided, well, there you go, that's right. So 1027 is 4.25. 4.25 divided by 107. So 4%. So basically we're down 4% in the month of November. So the dollar's down 4% in the month of November, and that's the story that's driving gold up and driving the indexes up. And you can see it's the exact same time the dollar's dropping, the indexes are rising. But it's usually 2 for 1. So is it 2 for 1? We have a let's say 41.50 here. And well, no, really it was from 42 because the dollar started falling here. So from 42 to 46 is call it 400. So well, we know what that's going to be. It's going to be 10%. 400 divided by 4,200 is 9.5%. So basically, just a little bit more than double what the dollar is. So the majority, you usually get a 2 for 1 ratio to the dollar. So in this case, it's a little more. So the vast majority of what we're seeing here is just a dollar move. But it's a dollar move, but it's like when you're looking at a river and it has a bank, right? And the bank, let's say, has a certain level, and there's a path. Let's say there's a path along the river, right? And that's the riverbank. And that path, you're telling your friend as you're walking along the path, and they say, well, does it ever flood? And you're like, oh no, it almost never floods. I remember it flooding in years. But then it floods. So now the usual level, the river goes up and down normally, but it doesn't usually go over the bank. Now it floods, it goes over the bank. It didn't happen in years, but it happened again because sometimes things go more than they should. But then when you're looking at it and you say, well, that is an unusual event and it will probably pull back, right? So usually you get a 2 to 1 move of the dollar against the currency, and it might go a little higher, but that's unusual, and it will probably pull back. Now, the question is, though, also, there's another factor, and the question is, has anything actually fundamentally changed in which the water level of that river is never going back down? And this is something we're all beginning to experience in little ways and shapes and forms, is, yeah, something is fundamentally changing in the world as far as rainfall. There's more rainfall than there ever was before. There is more, the ocean is rising. It's a fact, it's not a theory, it's not a guess, it's not like something people are making up. The ocean is measurably rising because the ice is melting. And I love the people who think, there's all these people use these analogies like you put, like if you have ice in water, right, and the ice melts, it doesn't raise the level of the water because the ice, even though it's above the water, is displacing X amount of water by the weight and so on and so forth. So that doesn't, so when they say, oh, that's not going to cause the sea level rise because the ice melts, but that's not what this ice is. This ice in Antarctica and in the Arctic Circle, the ice there is above ground. Okay, it's not in the ocean per se. It's falling off of land or you know, like large floating ice caps, and it does make a difference. It is going into the water and adding to the water level. And these are mountainous sized pieces of ice that are breaking off and falling into the ocean. And they do add up, and it's just it's a level that's not really conceivable. You know, I haven't gone up there, but my folks took a trip to Alaska, and they had some video, and you guys have all seen it probably on the web. And literally, you see a cruise ship. Wait, hang on, let's show you. What do they call it? Calving, ICALVING in Alaska. Yeah, glacier calving in Alaska. Okay. I want to see one like with a cruise ship in the picture so you can get an idea of the scale. Animated GIF, maybe. Shoot. No, images. Ah, here you go. Okay, there's a cruise ship. There, you want to get the perspective. Well, that's not a cruise ship. But look at the size of these things. That's what's falling into the ocean. And you can see, I mean, you can see what happens when it goes in. It's not a neutral event. It's displacing massive amounts of water, and there it goes, and boom, and here it comes, and this is extra water in the ocean. Anyway, so has something fundamentally changed that's going to cause the thing that's gone over? In this case, let's say that, you know, the dollar has gone down. Is there something fundamentally changed that's going to cause the dollar to stay down? That's what the question is. Well, what's that? Yeah, see what I mean? See, so here's what happened. What happened? Oh, this is a GIF. It's moving. This thing explains it. Okay, good. Anyway, so it's see the ice is on land. It's not already in the ocean, and it's melting away, and it's falling into the ocean, causing a significant amount more water in the ocean. And you can't get the water out of the ocean. The way it comes out of the ocean is by more rainfall. That's why we're having massive flooding all over the world. It's more water in the ocean, warmer oceans, more air evaporates, goes into the clouds, and comes back down as rain. But it's going to keep coming down. Just because it evaporates, it's not going to stay evaporated. Anyway, so it's the same kind of thing. So in other words, your riverbank floods, and now the path is flooded, and you say, well, it's going to go back. But then after a couple of months and it doesn't go back, you say, well, maybe something changed. Maybe the river is now higher than it used to be, and we're not going to have that path anymore. It's not going to exist anymore. You know, that's what happens, and that's what's happening around the world, and that's what happens with investing too, though. So when you see something happening, you can't say it's definitely going to come back because it always came back before. Something might have changed. But on the other hand, when you look at the NASDAQ, which is what we talked about yesterday, and we let's see. La, la, la. There we go. So yesterday I was talking about how it's time to adjust our hedges, and why. Mostly because the NASDAQ, which was here at 16.6, okay, so we topped out at 16.6. And the reason I called a short there, and the reason we made so much money in our portfolios on this market drop, is because I called it at 30 times earnings and said 30 times earnings is ridiculous. You can't, the NASDAQ cannot sustain 30 times earnings, because 30 times earnings means you're making 3.3% per year. So if if a bond is paying you 5% a year and the NASDAQ is paying you 3.3% a year, then bonds are better than NASDAQ. All right, that's all there is to it. So money is going to flow slowly but surely out of the NASDAQ and into bonds. And we're actually seeing that happening. It's something I talked about today a little bit. We're back at that level. And this is a problem too, because if we're back to 30 times earnings on the NASDAQ now, and we're back to 16.6, well, that means that we haven't made any progress at all as far as earnings go on the NASDAQ. And when you consider that, and you think about companies like, where's my thing? Too many tabs. So the overall NASDAQ is flat in earnings, right? But look at the Magnificent Seven. Here's Microsoft. Microsoft's earnings since 2022 are up 10%, okay? And 10% of Microsoft is more money than I mean, the whole NASDAQ maybe makes $1 billion, and Microsoft makes, here's 20 billion of it from Microsoft. I'm sorry, not 20 billion, 40 billion. Well, right, whatever you want to call it, 20, it's a good 20, yeah, from 2022, it's $40 billion more dollars. All right, then we look at Apple. Then we're keeping track of this. Let's keep track of this. 40 plus Apple's increase 394 to that's no increase, so Apple's not doing it. NVIDIA is going to be crazy. NVDA. NVIDIA was making I don't think I looked at the profit from Apple. Oh, look at NVIDIA. So NVIDIA was making 10 billion, now they're making 30, so they're good for 20 billion. And look at what they're projecting next year. Holy crap. Wow. Wow. It's crazy. So NVIDIA coming out of nowhere, right? Okay, let's go back to Apple because I think I looked at the wrong number. Yeah, profit, I'm sorry, so no, profits are flat. So Apple's profits are flat. NVIDIA is adding 20 billion. Microsoft is adding from 2022, 72 to 83, sorry, 11 billion. So it's 11 and 20 is 33 from Apple and NVIDIA. And then Google, and don't forget, Google gets counted twice. Well, let's not get into that every time we discuss Google, but it drives me nuts. 59 to 73, so that's plus 13, let's call that. And that's going to be 26 from Google. So plus 26 from the two Googles, 59. And I forget, whoever the other one, whatever the other ones are, it doesn't matter. So you're talking about, a good 10% of the NASDAQ's increase in, it's not an increase because it's flat. So in other words, these guys gained, let's say $100 billion. The rest of the NASDAQ is essentially flat. If you take out the increased profits from 2022 till now, that's going to come out to about $100 billion. And that's 10% of the NASDAQ's total profits. And the total profits haven't changed because we're still at 30x. So the total profits of the NASDAQ are still where they were back in 2022, back when we were at the highs. And if it wasn't for these companies, the entire NASDAQ, if it wasn't for these companies adding $100 billion in profit, then the entire NASDAQ would be down $100 billion, not even flat. That's not a strong market. You gotta think about those things. You gotta think about the fundamentals that are driving the numbers that you're seeing. All right, so the short-term portfolios had been up tremendously, and so we made adjustments and got more bearish. And I made a call today to get even more bearish because while we were doing the adjustments on the SQQQ, what we did with the SQQQ, we have this long. And we have these, and I was kind of focusing on this stuff. And what we did is we brought back the things that we have this profit on. We brought back the short calls, So now we don't really have any covers, no significant coverage on the short calls. And then today I said, well, you know what? This is actually not a big number considering how much money we have. You know, we have 300,000 in cash. And I said, considering we're sitting on all this cash and we're already up 50-something% on, or actually today it's 60%. We're up 60% today on these short calls. And I said, well, if we're up 60%, let's buy them back because it really isn't that much money. So we're buying 100 back for like $30,000. It's like $311 per contract. So why not buy them back? It's not a big risk to us. All we're doing is taking $30,000 out of $300,000 and buying these back. But what that's going to do is we're going to be 40 and 250 now, and it's going to make our hedges much more responsive because we don't have the negative that comes from the 25 calls. We only have the positive from the 10 calls, and the delta on the 10s, since they're deep in the money, is going to be probably in the 80s. We're going to get most of the move of the NASDAQ we're going to collect. So now we have a very, very, very strong hedge in case anything goes wrong between now and New Year's. And that makes me happy because, frankly, every time we get past New Year's Eve and nothing blows up, I'm so relieved. Because unfortunately, that's the world we live in now. I mean, you know, New Year's Eve, you know, all around the world, in cities everywhere, you know exactly to the minute where a very large crowd of people is going to be gathered in places that have very little security. So I'm saying basically in Times Square, in Piccadilly Circus, in Edinburgh, you know, wherever you happen to be. Right, in Tokyo, you know exactly where the celebration's going to be and where all the people are going to be, and that's exactly what you would be looking for in a terrorist attack. So I don't go to those places anymore. I don't let my kids go to those places anymore, and I used to. I used to go all around the world and have fun on New Year's and stuff, but it's just it's too scary, really. And financially too. So I prefer, every holiday season, I prefer to have some good hedges in place because that's the kind of thing, you know, a big terrorist attack somewhere in the holidays is the kind of thing that can really knock the market out. And why should we risk that? You know, why should we risk it in our portfolios if we can just spend a little bit of money and make sure it doesn't happen? You know, it's like a catastrophe insurance, but it's good to have. It really is. So a lot of times I'll get defensive around the holiday season, and especially when I think the longs are stretched. You know, so things can go down and stay down, and that's very bad for your portfolio. You don't want to have that kind of damage done to your portfolio and then have to wait a year or so, like we did in 2008. Right? There's massive, massive damage. It all came back, but those are lost years. If you don't have the hedges in place, those are years that are lost in your portfolio of gains that you're expecting to make. Sets you back tremendously. So that was what we did yesterday. And today, dun, 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 there we go. I love that. I love the AI images are so good. So today, you know, in the front of the Wall Street Journal, I don't know if it's still there, but oh, here's the Wall Street Journal. Or was it Bloomberg? Might have been Bloomberg. Maybe not. Oh, there's Bloomberg. Nope, that's not Bloomberg. Is that Bloomberg? Nope, that's the same thing again. Oh, yep, he's still there. Bill Ackman. So this was the front of Bloomberg this morning. It's been demoted a little bit. But you know, I always look at the papers in the morning, or the web pages of the papers anyway, to see what's going on. Nobody reads the actual papers anymore. And they were making a big deal about this. And whenever you see that, you have to say, is this real? Is this true? I know Bill Ackman. I've met the guy. I almost did business with him on a company once. You know, he's a guy. He could easily be wrong. In this case, you know, he's jumping the gun. But when you get somebody whose name is recognized like that and they make a statement like that, it goes all over the place. You know, it's funny because Charlie Munger died yesterday, and you know, and it's a big deal. It is. He's a, you know, financial giant of the industry, blah blah blah. But I feel bad for him because it's always like Warren Buffett's partner, Charlie Munger. You know, he doesn't get to be his own person. He's always Warren Buffett's partner. You know, when Warren Buffett dies, they're not going to say Charlie Munger's partner, Warren Buffett. It's not going to go that way. It's the other way around. But it just makes me think of like how fleeting fame is, because okay, fine. So everybody's making a big deal about it today, but literally next year, his name will stump somebody on Jeopardy. You know, it's like they'll say, you know, this man was Warren Buffett's partner, blah blah blah, and you'll see like 3 people who are supposed to be really smart to be like, who, what? And it's true. It's true of anything though. It's really interesting. It's yeah. Well, who is it? Osmondeus. You know, it's like behold, and all these works will turn to sand, or whatever the hell that statement is. But it's how it is. Even if you imagine that the human race just goes on and endures and so on and so forth, you know, you think about how many presidents can you actually name out of 43? You know, it's like how far would you get? Would you get half of them? And those are presidents of the United States. You know, you know the richest people on earth from before the 20th century. Who were they? Do we even, you know, are they even remembered at all? You know, and here's Charlie Munger, a multi-billionaire, a figure who has dominated our entire lives. Our entire lives, this guy has been a known financial giant, right next to Warren Buffett. And now he's dead, and it's all, the whole thing just sort of fades away. I guess because I'm old, I'm starting to think about this stuff now. It's like you're not going to be remembered. Stop having ego about it. I think that's the thing I'm talking about. It's like stop thinking you're going to be remembered in some fantastic way. I mean, I was going over some family photos of my mom, and she's got these old pictures, right? People from the 1900s, you know, like seriously old family pictures. And I'm like, well, who's that? And she's like, I have no idea. She's like people in the family pictures. She has no idea who they are. You know, and it's funny because some people, they write stuff. It's God bless my relatives who used to write on the back of cards who people were on the back of the photos. They would write down who people were, but then that fades out. That drives you nuts because it used to say who they were and now it doesn't. It's funny because I mean this is in you know less than 100 years. It's that Ringo Starr song "Photograph," right? And all I have is a photograph. I mean, I guess we have better information storage and retrieval now, so maybe it'll be different in the future. Maybe you'll have more closer, better ties to your family going back as we digitally can retrieve all this information. But it's, you know, maybe your Wikipedia entry will last, you know, 1,000 years. But someone's got to want to look for it, right? Because it doesn't help if you don't look for it. You know, like Rutherford B. Hayes, let's say. You know, what do you know about the man? He was president of the United States. It's weird. It's weird. What's weird to me is it's weird that people strive. Like you think of that Donald Trump and whatever. People strive for fame. People do whatever it takes to get known. These influencers and things like that. They try so hard to be known, and the people write these articles and people write books. And I watch the shows on the TV late night, and they're interviewing people about all the important things that they're doing, and so on and so forth. And it's all dust in the wind. You know, they do their stuff and they die and whatever. It's like a Shakespeare. Your time upon the you flit upon the stage and then that's that, and then you're gone, and the next actor steps up and does a role. You know. So anyway, so you know, because Charlie Munger, I'm a big Warren Buffett fan, obviously. And of course I pay attention to Charlie Munger, but I've never said I'm a Charlie Munger fan. I've always been a Warren Buffett fan. Munger's a side guy. He's a clever, witty, smart guy in his own right. But you know, it just seems odd to me. It's like we all want to be remembered. You think you're going to be remembered, but the reality is you're not going to be remembered. Doesn't, you know, even if you're Charlie Munger, you're not going to be remembered. And that's kind of weird. I mean, it makes you just wonder, you know, maybe your priorities are misplaced somehow. So anyway, that's my thought for today. That's my eulogy for Charlie Munger. It's not very complimentary. Anyhow, so Bill Ackman, right? By the way, that's what got me started on that track. A guy who's very full of himself. Let me tell you. But anyway, so Bill Ackman thinks he knows everything. Oh, and that's, by the way, a great Charlie Munger quote. Charlie Munger said, "I would rather have a guy with an IQ of 120 who thinks he's got an IQ of 100 than a guy with an IQ of 150 who thinks he has an IQ of 170. And so what he's really saying is, he's like, people who overestimate their own intelligence are extremely dangerous people. People who think they know everything are very, very dangerous people. They're the ones that get in big trouble and make serious mistakes. Anyway, so Keynes, hey, still remembered, still quoted. Yeah, that's what you got to do. You got to say something really, really good. You have to have a really, really, really good quote. I must have had some good quotes at some point. I should hire someone to go through all my stuff and find a couple of good quotes that I can start making memes out of or something. But so, you know, what I was saying is, like, you know, look where we are. The S&P was 4,600. Now it's 4,554. The NASDAQ was 16. Now it's 16. This is back in, you know, talking about the August lows. So when the dollar, I'm sorry, when the dollar's at its August lows, this is where the indexes were. And so the Russell was 2,000. Now it's 10% below 2,000 still. So we haven't made any progress at all. And it's effectively all the dollar. The indexes went down and they came back. They went down when the dollar went up. They came back when the dollar went down. And that's where we are now. But this has been a pretty good floor for the dollar. And now we have to think about, fundamentally, has anything changed that's going to make the dollar get weaker? So what has changed? Well, you've got Bill Ackman trying to tell you something has changed. He's saying the Fed is going to start cutting rates. If we do that and other banks don't, now this is also relevant though, if we do that and other banks don't cut rates, then we are going to be relatively weaker to the other banks. But if all the banks are cutting rates, then there's no net effect. It's not going to weaken the dollar for us to cut rates if all the banks are cutting rates. So now you have to pay attention to not just what the dollar is doing, but what all the other reserve banks are doing. All right. So then you say, okay, well, what else is going on? Well, the OECD says we're actually slowing, and they're revising their estimate of growth down by 6.8% from 2.9 to 2.7% for next year. These are our pre-COVID levels. Nobody globally, US, China, Euro, nobody is at their pre-COVID levels. China is the second biggest economy in the world, and they are a mile below their pre-COVID levels. We are, oh, this is misleading because it starts at 1. So 175 to 2.5, basically it's 2/3 the growth of where we were. You know, Europe wasn't growing anyway. It doesn't really matter. Europe's doing the same nothing they were at the time. And the OECD is saying the risks are tilted down, that there's actually a lot of things that they see on the horizon that are dangerous. And Jamie Dimon just said that this morning. He was at a conference and he basically said, I'm expecting a recession. He goes, all the numbers point to a recession. Stop kidding yourself. Now, the same OECD report is talking about the likelihood of rate cuts, and unlike Bill Ackman, they're like, no, this is what 2024 is going to look like. At least first half of the year flat and not much of a cut if there is one towards the end of the year. You know, other places in the ECB, they say no cut at all. Now that, starting here towards the end of 2024, if we start cutting, I'm sorry, in the middle, if we start cutting, and that's from where we are now to back to 4.5, let's say, so 0.75 cut. So if we start cutting and Europe doesn't, then we will weaken the dollar. That will weaken the dollar. That will be a fundamental change. But if we are cutting while everyone else is cutting, and we're all going to intersect here anyway, then realistically, there'll be no change. If everybody ends up cutting to the same place, there won't be any change in the fundamental valuation of the dollar. That's what matters. It's how the dollar is in relation to other currencies. So if everybody's cutting, we won't get the effect that Bill Ackman is looking for and that the markets are pricing in. They're pricing in a boost because the dollar gets weak. The dollar will not get weak if everybody cuts. It's a big, big deal. People don't understand this. Analysts don't understand this. Economists don't understand this. It just drives me nuts. Now China is they're doing two things. They're stimulating, they're bailing out the real estate market bit by bit by bit. They keep coming out with different ways to like refinance and encourage the banks to refinance and doing everything they can to stop the real estate from being a complete catastrophe all at once. They're spreading it out over like a decade if they can. They're also trying to make other parts of the economy more important than real estate, because right now real estate is like a third of their entire economy, and that's and of course when it has a crisis, it threatens to destroy their entire economy. So they're working on that, but at the same time they're manipulating their currency. And by the way, China's currency is pegged against the dollar, and you know, like the Swiss pegged their currency too. Pegged is manipulation. It means that if it moves and it doesn't keep pace with the dollar, we're going to inject or withdraw liquidity to make sure it keeps on track with the dollar at the same exchange rate. That is just basically your policy is manipulation. And that means it's all bullshit. You know, Switzerland almost bankrupted themselves trying to keep their dollar pegged. They finally gave up because they couldn't do it. They had to make an adjustment because they could not keep up with the way the dollar was rising. There was no way they could keep their currency up at the same level. They just didn't have the reserves to do it. It's tricky. But China has China's like us. China exactly like us. China has written themselves checks into debt that's almost the same as ours. It's a couple 100% of their GDP. China has done what we've done. They've completely wrecked their economy and pushed themselves into debt by trying to artificially avoid a recession. So when China's economy was in trouble during COVID and even before COVID, but from 2008 on, basically, when China had troubles and when they were they did infrastructure projects, they did bank bailouts, they bought real estate, China took over companies, they took over banks, whatever it took, they did everything they could to make sure their economy didn't fail, even though it was failing. And this is like if you have a patient in the hospital and they have a hole in their chest and they're bleeding and they require, pints and pints and pints of blood just to get through every day, there's a cost to keeping all that stuff going, right? And if you can't fix the hole, it's just going to be tomorrow the same thing, and the next day the same thing, and the next day the same thing. And eventually the hospital goes broke trying to save somebody's life. Eventually they have to give up. So you can't just keep economies on life support forever. And that's, again, why the Fed rapidly had to raise rates. They had to give themselves some breathing room because God forbid an actual new crisis comes along and all of a sudden it won't matter. And what's a new crisis? Let's say a nuclear plant blows up inside of America and like a Fukushima kind of thing. Let's say something like that happens. let's say a big chunk of meteor rock strikes somewhere in America and causes massive damage to a city. Let's say huge super hurricanes, flooding, whatever, a huge drought that dust bowls the middle of the country, which we're very, could happen anytime. Wars is another one. There are many catastrophic things. A virus. Oh, this is very science fiction-y. Imagine a virus that infects a huge portion of the population and causes like a shutdown where nobody can even go to work. That would be crazy. Crazy things happen. And you've got to have, you've got to be able to react. You've got to have dry powder. You've got to be able to do something. You can't be in a position as a government of not being able to do anything about a problem. But that's where we are when you're $34 trillion in debt, and your interest payments on your debt are $1 trillion a year. You may have some trouble coming up with extra cash. We are now going to have deficit interest payments that are one of the biggest expenses in our budget is the payment of the interest on the debt we already have. And that then puts us into deeper debt. And the only way to fix that is to, either raise more money by taxing people and corporations, right? You got to either get more money in or spend less money, but we've already cut the government like 10 times. There's not much government left. There's so little government left that we can't even function in Congress. It's like there's not enough money to run the basic government services. We've cut back everything. We don't support, there's no social safety net, there's no nothing. We've already cut everything we can cut pretty much. So we aren't going to be able to cut. Nobody wants to raise taxes. And when we grow the economy, if we're growing the economy, the GDP is up 5% as of today, only for the quarter. It's a spiky thing. It's going to go back down. But the GDP is up 5% today. If we grow the economy at 5%, that's a good way to get out of debt, but that only if you're not racking up more debt. But we're racking up more debt. So even the inflation is only inflating our debt, and it's also making the interest. If the interest rates go to 5%, and we've got 33 trillion in interest rates, then our interest payments will be 1.5 trillion a year. So that's not helping either. Debt clock. Yeah, almost 34 trillion. The budget deficit is $1.75 trillion, and the payment on debt, interest on debt, is now 689. It was below 300, and now it's 689, and it's going to be 1.5. How crazy is that? At 5%, this number is 1.5 trillion. It's $1 trillion more than it is now, pretty much. That's what we're heading into. Well, I wonder if this got a little warning sign. It's like danger. So this is bad. This is beyond bad. This is a catastrophe that is happening right in front of us that we ignore. Federal spending, $6 trillion. $6 trillion a year, and the national debt is 33 trillion already. And we are, we're not. It's ridiculous. So if we're running a $2 trillion a year deficit for the next 10 years, that's 20 more trillion. That will put the debt at 50-something trillion. And if if we're still running it, if we're running at a 5% interest rate, then we're going to need $2.5 trillion to cover our debt. So 1/3, and this is where Japan is now. 1/3 of our budget, 1/3 of our entire budget will be debt service. That's where Japan is now. And that's with super ridiculous low rates. If Japan was paying a normal rate of return, it would be 60% of their budget would be debt servicing. And that's effectively a failed state. If it wasn't for the fact that we have fake money, and everybody has fake money, all money is fake money. There's nothing backing it up. If we didn't have fake money, and the U.S. and Japan and China could all just print money by writing checks, if that wasn't the case, then everything would just collapse. There's no money. We're just making it up. But we're so addicted to making it up, and we're so used to it, and we've accepted this concept that we just continue to do it now. It's like a game of Monopoly where you can print, it's like if you have a bank in Monopoly and you cheat and you take money out of the bank, and you can now afford to buy any property, you can outbid anybody for any property on the board, right? You've got all the money, you've got the bank money. It doesn't matter what somebody else has, you've got the whole bank, you've got all the money. So if you're free taking money out of the bank and there's no consequences, sure, of course, you'll just buy everything up and make everything better. You're not going to make it better for the people who are other people who are playing. They're going to go bankrupt, okay? And you're going to go bankrupt too. But if you can outlast them, you can think you're going to win. Eventually there'll be nobody to pay you rent, right? Fine, you bankrupt everybody else, but nobody can pay you rent. So you got a lot of property that you have to maintain that doesn't produce anything. That's the flaw in Monopoly that people don't understand, right? Is that when you wipe everybody else out, what happens after that? See, the goal in Monopoly, and this is basically what's wrong with American capitalism in general, right? You're taught in Monopoly that when you bankrupt everybody else and you're the last person standing and you've got all the property, but that's not true. Ask any commercial real estate landlord in Manhattan if that's true. It's not true. If you have no tenants, you will go bankrupt too. But there's no after party in Monopoly. It's like you win the second you kill all your competition, you win. They declare you the victor. But you're the victor of what? You're the victor of ashes. You're standing over the destruction you have wrought. And that's what capitalism is. We're in end stage capitalism now. We have destroyed the planet and we're fighting over what's left. And we're having all these things and everybody's, and all this stuff, and everybody's ignoring still the climate change and everything else that's going on. But everything's a Pyrrhic victory. You're not going to gain anything by all this. There's not going to be anything left to win. It's over. And we still can't change. We still refuse to change. Even Monopoly, I'm pointing this out about Monopoly. It's very obvious, right? It's like when you win the game, if you keep playing, what happens? It's a very boring game. You've got all this stuff. Nobody can come to your hotel. Nobody's got any money to play to do anything else with. Therefore, you are the winner of what? You're the winner of a whole bunch of empty buildings. And you still have to maintain them or they will crumble to dust. See, same thing. The theme of the webinar, everything crumbles to dust in the end. And you've won what? And you've gained what? It was all, you could have all lived together in peace and harmony, and everybody could have shared, and everybody could have had their own blocks, and you could have visited each other and so on and so forth. But instead, you decided that you had to wipe each other out. And so you end up with nothing, and you all end up with nothing. You kill them sooner. That's all you accomplish is wiping out your opponent sooner. Then you will get wiped out too. Anyway, so China. Speaking of wiping each other out, and and again, that's a theme I talk about a lot. Is you've got people like Ackman, who's one of the puppeteers, and he gets to go on Bloomberg anytime he wants, and he gets to talk his talking points anytime he wants, and make the dollar go up or down or sideways, and make the markets go up and down when he wants it to. And why do they do this though? Sure, because he wants the market to go up because maybe, not necessarily Bill Ackman, but maybe he's selling. Doesn't want to sell on a down day. He wants to sell on an up day. So he says something bullish, knowing that he moves the markets. And then here's the big money leaving the market. Market goes up, but the money goes out. And look at the whole year. This has not been a really good year. This is not a good net year for money flowing into the market, but the market still goes higher and higher and higher. That means there's very little really supporting this kind of rally. So the GDP was high, and the Fed needs to calm that down. They can't have this thing running away from them. It's going to be a disaster. Again, obviously, these rates, if this rate, well, you can calculate it, right? Interest on debt 689, U.S. debt 33. Therefore, we're paying 2%. This is right now 2%. Yet the bond auctions are going badly, and because the bond auctions are going badly, it's a sign that you're not going to be able to roll this debt over at 2%. You're going to end up at 3%, 4%. That's going to be, where I said, over $1 trillion of debt service very quickly. And we don't have no way of doing it, but if we're not going to raise taxes and we're not going to cut spending, then what happens? Just more debt, more debt, more debt service. So the bond sales have been going poorly, and that's been going on for an entire month now. The first bond sale that went really badly was about 3 weeks ago. We had a 10-year auction that had probably one of the worst auctions in history. Probably one of the like nobody remembers a worse auction as far as nobody wanted the bonds, nobody was bidding, the price went up to like 5%, and everybody freaked out. But then there was a story that got floated, which is bullshit, was never substantiated, that the foreign bidders were blocked by hackers, and otherwise they would have been a lot more participation. This was an untrue story. It was just an excuse for why it's like the dog ate my homework. It's like an excuse for why the auction went bad. It was not true. The auction went bad because the notes aren't high enough and the rates aren't high enough, and you're not being compensated for the risk you're taking lending the U.S. government money for any kind of period of time. We are in default. You can't, in other words, you say, how are you going to pay this back? If you're a bank, how are you going to pay this $33 billion, $34 trillion? How are you going to pay it back? How are you going to cover this? You have variable rate interest that is currently 2% when the Fed funds rate is 5%. 5.25% actually. So your rollover on your debt is going to be almost double what it is now. So what is your plan to cover this, Mr. Government? Well, my plan is to go further and further into debt. See, and the banks, well, how about if you can cut some expenses? No, we tried that. No, there's nothing left to cut. We cut everything. So you can't cut your expenses. You can't cut your expenses. You don't have money for repairs, for infrastructure. You're in an environmental crisis that you've allocated no money to, and you're not going to fix it. You're unable to raise taxes. You're unable to lower spending. None of this is going to change. And you want me to do what? To lend you another, well, $2 trillion this year? Well, I'll lend you the money, but I want a priority position. This is what the bank's going to say. I want a priority position, which you don't get, and I want higher rate of return. I don't give a shit what these people are getting. I want my 4 or 5%. I'm not going to lend you money at below prime rate. We're in this cycle now. If we didn't have this myth of being the U.S. government, blah, 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 we'd be unable to borrow. If we were a person and we show this, or a business and we show this, we wouldn't get any money. We'd be shutting down. away. Stop. How can this go away? There it goes. Okay. So bond auctions, and the computer did that. I like that. Warren did that. I said, just draw me a picture of a bond of a guy who's disgusted by the bond, and it like actually stinks, and that's he did that. So anyway, so the poor bond auction, blah blah blah, and it's bad, and it's a problem, and we're in trouble, and this is insane. You know, you see the market just going up and up anyway. It's really crazy. So now let's see what the beige book says, because it's that time. Now we're up to the beige book. I guess we'll talk about this next week. We're going to talk about a trade of the year next week. That's my plan. Next year, trade of the year. In chat, we are analyzing the trade of the year. We're down to our final 5. Where is that? Oh, here we go. So we're getting down to our final 5. We have like 7 left in the final 5. So we have to cut a couple more. And tomorrow probably I'll be featuring that, and we'll be talking about the trade of the year. But we've had the computers run some extra analysis on them. We've come up with the top 5 and the bottom 5, which we pretty much eliminated, and why we eliminated them. But at the moment, I've only got a half hour left, so let's get over to the Fed and see what the beige book says. Beige book. Not actually ready yet. We got 3 minutes. I imagine they'll add a column. Here you go. Open that in a new window. Woof. All right. Let's see if we can the national summary. Oh, that's good. Oh, is that a national? That's not really a national summary. No, I don't trust that. Overall labor prices highlights by day. Oh, I guess that is it. All right, so let's see how far we want to go. All right, we don't want to get to the Federal Bank of New York. Bank of Boston. Okay. So this, I guess, is the national summary. This is a job for Claude. Pick your AI. Claude. What is this? Is this how I sign into Claude? Yeah, I think. Are these my chats? Yes, they are. Okay, great. We are going to compare the previous and current beige book to see what's changed and figure out what trends are brewing. Here is the, what was it, October 18th. Here's the October 18th report. Okay. And then it should be 2 o'clock, so hopefully the next one's out. Uh-oh. There we go. Right, that's New York. That's Boston. Oh, that's where we go. And I guess for consistency, we need to know what they call this, November 29th. Okay. I do not have access. Give me a break. I just uploaded the TXT. Please read it. We had trouble last week with this thing too, didn't we? Oh, for God's sakes. Here it is again. All right, well, now we got to go back to this one and recopy it. That's so annoying. Okay. La-di-da. Okay, and here is the new report for November 27th, 72023. See how he remembers that we were trying to compare it, so he doesn't bother with the summary of this one. So let's see what he says first, and then we'll go read it. So economic activity has slowed slightly more over the past couple of weeks. Both reports indicate a modest weakening, but the language shifted from on balance slowing in the November 17th report to little or no change in most districts on the 29th. Why is he saying? All right, let's assume. Okay, labor markets continue to gradually ease with employment growth flat to moderate. The November 29th report notes hiring is less urgent and worker availability has improved somewhat. I guess I should have said November 29th. Price increases remain modest overall. Moderation continued. Input cost pressures persist, especially for service firms. Pricing power is declining across sectors. They can't pass on the costs anymore because consumers are at the end of their ability to absorb more price increases. This is what happens when wages do not keep up with inflation. There's a physical limit to how much the companies can pass on to consumers, because all they end up doing is anybody who raises prices is taking money away from somebody else. You're forcing consumers to make choices of one thing or another because they can't afford both. They don't have any more money. It's over. We spent the COVID money. We spent the savings. The raises were inadequate to get us back to an equilibrium state. Therefore, now you're slowing the economy down because the consumers can't afford to keep up. And that doesn't mean that the cost at the firms is not going up. Sometimes they still have, there are real costs that may have to, like commodity costs that have to be passed by. And if they can't get passed along, then the firms just basically end up having lower margins. And again, this is not, this is not what a robust economy when you have to say these things. Consumer spending remains uneven, but is trending downward. And again, record high market. And you're not supposed to have words like this. Consumer spending uneven, trending downward, especially discretionary and durable goods. Tourism continues to be a bright spot. Summer's over. What next? Manufacturing activity is mixed. And by the way, a lot of the spending that consumers are doing, and I'm in Florida, I talk to a lot of people who have grandkids visiting and so on and so forth. It's the kind of stuff where it's like, yeah, it cost a fortune to fly down. The hotel was ridiculously expensive, but I haven't seen my grandchildren in 3 years or 4 years, or when the hell did this thing start? 2019, 4 years. I haven't seen my grandchildren in 4 years, so I put up the money to have them come down. That's what's going on. That's why you have robust demand. People haven't seen their families since COVID began. People haven't visited their friends. People haven't gone to places that they were supposed to go to. Kids haven't gone to Disneyland, stuff like that. You know, you promised your 6-year kid in 2019 that you were going to go to Disneyland next year, and now it's 2023. They've been waiting a long, long time for that trip that you promised them. So even though Disneyland is now a $1,000 a day thing, a $1,000 a day trip for people, what are you going to do? No, I'm sorry, it's not even 1,000 days. It's 1,000 a day just for the tickets for 4 people. It's oh my God, I can't even imagine. My kids used to go to Disney like every single year. This has gone insane. So when you say tourism is a bright spot, it's because of the backlog of travel that's been going on. It's not because people are taking trips because it's great. It's not because people are swimming in cash and don't know what to do. It's not like everybody has a desire to go around the world. It's that everybody has put off doing this stuff for years, and now they're getting a chance to do it. But this thing is going to normalize way lower than it is now. That's why there's no such thing as a travel stock in our portfolio. Manufacturing activity is mixed. Outlooks have weakened recently. And again, record high markets. Residential and commercial real estate markets are declining demand. Record high markets. Multifamily development is slowing in record high markets. Near-term outlooks weakened further over the past couple of weeks. Record high markets. In summary, the trajectory of economic cooling, labor market rebalancing, gradual price moderation remains intact. However, both reports indicate increasing downside risks and uncertainty about 2023 as interest rates continue to bite. Record high markets. So is the data wrong, or are the record high markets wrong? Got to take this stuff seriously. Back to the Fed, right? Back. I know that's something I want to do. So beige book, November 29th. Oh, that's where November 17th came from. I mean, nah, that's where it was confusing. So on balance, and again, record high markets. On balance, economic activity has slowed since the last report. 4 districts reported modest growth, 2 indicating flat, and 6 slight declines. So half are modest or flat, 6 are declining. Retail sales, including autos, remain mixed. Sales of discretionary items and durable goods like furniture appliances declined on average as consumers showed more price sensitivity. Travel and tourism was generally healthy. Demand for transportation services was sluggish. Manufacturing activity was mixed. Manufacturers' outlooks weakened. Demand for business loans decreased slightly, particularly real estate loans. Consumer credit was fairly healthy, but some banks noted a slight uptick in consumer delinquencies. It's the beginning of strains, right? Agricultural conditions were steady, slightly up. Farmers had higher selling prices. Yields were mixed. Commercial real estate activity continued to slow. Office segment weak. Multifamily softened. Several districts noted a slight decrease in residential sales, higher inventories of homes. The economic outlook for the next 6 to 12 months diminished over the reporting period. And the market is at record highs. Labor markets, demand for labor continued to ease because we're slowing. Districts reported flat to modest increases in overall employment. Now, that's not actually good because if we don't have the workers can't get raises. The workers can't get raises. They're not going to catch up with inflation, and they're not going to have the money to spend on the stuff that everybody is worried about. The majority of districts reported that more applicants were available. Several noted that retention improved as well. Reductions in headcounts through layoffs or attrition were reported. Some employers felt comfortable letting go of low performers. However, several districts continue to describe labor markets as tight with skilled workers in short supply. That hasn't changed. And that also is not good because it crimps growth. You can't grow if you don't have any intelligent people to do the work. We know what happens when you don't have intelligent people to do the work because we all go to fast food restaurants, right? You know, not to disparage the average fast food worker, but I mean, you know, these are the lowest common denominator jobs, and you see it. You go to these retail places, you go to the stores, you go to the things. This also slows the economy, right? When you're sitting there for 45 minutes in line waiting to get a hamburger for lunch because they don't know how to work the machines and the person in the back can't cook a burger and blah, blah, blah. This is what happens when you're scraping the bottom of the labor barrel to get your employees. When there's a lot of unemployment, then you have, you know, there's the opposite problem, right? When there's a lot of unemployment, we had college graduates working at McDonald's because there were no other jobs. That's when McDonald's is humming, though. That's great for McDonald's. They got a whole bunch of really smart people working there who are way overqualified for their positions. So now we have the opposite problem. Another problem is that McDonald's can't find anybody who knows anything to work there. It's not, they don't pay enough money to get people to come. And that's all the fast food places. It's a Walmart, it's Kmart, people who stock the shelves, the guy who gets your shoes in the thing and can't figure out the organizational system in the back. And so he can't, you know, like you go to get a shoe and you ask the guy to go back to the back and find your shoe. He takes a half hour and comes back. And meanwhile, there's 4 other people behind you who are waiting and they want to try a shoe on too. And the whole thing grinds to a halt. Society grinds to a halt when you don't have skilled, qualified people to do basic jobs. So wage growth remained modest to moderate. As many described easing wage pressure, several reported declines in starting wages. Some wage pressures did not persist, however, and there were some reports of continued difficulty attracting and retaining high performers and workers with specialized skills. Price increases largely moderated across districts, though prices remained elevated, moderated but elevated. In other words, there's no retraction of inflation. It's going up, but slower, but still up. Freight and shipping costs decreased for many, while the cost of various food products increased. Several noted that the cost of construction inputs like steel and lumber had stabilized or even declined. And again, that's a slowdown in the economy. That's not a good thing. Rising utilities and insurance costs were notable across districts. Pricing power varied. Service providers finding it easier to pass through increases to the manufacturers. 2 districts cited increased cost of debt as an impediment to business growth. That's another problem we're all facing. Most districts expected moderate price increases to continue next year. So inflation still coming down the pike next year. Federal Reserve, economic activity was down or flat. Oh, these are districts. Employment stable, results were not quite among manufacturers. Well, it doesn't matter what the districts did. New York, economic activity weakened. Philadelphia, business activity declined. This is horrible. District's economy contracted slightly. Did anybody have a good time? Richmond, the regional economy grew slightly. All right. Look at Richmond. Atlanta, economic activity grew slowly. Another winner. Chicago, economic activity is up slightly. Winner. Economic activity is slowed. Ooh, St. Louis blew it. Up, Minneapolis down slightly. Kansas City declined slightly. Oh man, we had 3 in a row. Up, Dallas, the 11th district's economy expanded at a slower pace, but they're going to be screwed with the oil business in decline. Did I say anything about the oil business? No. San Francisco softened slightly. And that's it. And then you get into the specific reports. So on the whole, this is not kind of report you expect to read when your markets are at record highs, when they're asking you to pay 30 times earnings for the NASDAQ because things are so amazing. This is not so amazing. That's why we're hedging. That's why I decided today, before I even saw this report, that's why I decided today to get more aggressive with our hedges, because frankly, for $30,000 lousy dollars, I don't mind the risk. $30,000 has made us tremendously more bearish at this stage. And if we're wrong, then we lose $30,000 basically. If we're right, we're going to stabilize and we'll probably make more money on a dip than we would on a rise right now. And all we're saying is that this is a NASDAQ, and we think there's a good chance that we're going to get rejected at the same place we got rejected last time. And that rejection last time was very harsh. See how look at the rise. Look how we came in. Went up and down. We went up and down. Then we went up again. Then we went up again. And then here we had a very little down. Here we had a big down, but we went back up. And now we're going like this. So same exact pattern basically. Climbing, climbing, climbing. Maybe a few more. You know, I'm not saying we're going to go down tomorrow, but I'm saying we could go down tomorrow. At any point now, we could go drastically lower. And this is pretty drastic. This is a short, sharp shock in 1 month, giving up half of the gains. That would take us back to like 15.5. That's a pretty significant fall. So we just want to be ready. And also, we're still contending with this. I'm sorry, this is the NYSE. It's not the NASDAQ. But you know, we're still contending with this death cross on the NYSE. So on the broadest index of stocks, the 50-day moving average is still below. And here's the thing. Will this hold up long enough to start this curving up so that we can see a what they call a golden cross, a bullish cross in the near future? This would have to sustain much higher. And we've done math before. The way you do the math is you say 16 minus 555. So let's say it's 500 points, right? So it's 500 points on the 200-day moving average is going to move you up 2 points a day. 500 points, it's not 500 points, it's 600 points on the 50-day moving average is going to move you up 12 points a day. So we're going to gain 10 points a day. As long as we're at this level, this line will close in on this line by 10 points a day. If I did that right. 10, 50. I think I did that right. Yeah. So let's say this moves up 10 points a day. So it's 402 to 555. So if we can hold up at this level, if we stay above 16,000 for 2 weeks, maybe actually 3 weeks, if we can stay above this level for 3 weeks, for 15 days, then this blue line will cross over this, back over this red line, and we will be in a bullish situation and potentially looking at breakout. But that's only if we stay up and around here for 3 weeks. So that's, and then you look at your calendar and you say, okay, well, Phil says 3 weeks. That means we got 1, 2, 3. So basically right here, right before Christmas, we have to maintain this all the way into the holiday in order to have this blue line no longer be threatened by the red line. And that's the 50-day moving average and the 200-day moving average. Is it possible? Is nothing going to go wrong for 3 weeks? I don't know, but I mean, look at this report, and then you can look ahead to the data and say, well, what data is upcoming in the next 3 weeks? And I can actually do that because it's right here. So we have this week, we're pretty much good. We have personal income, personal spending. That's a big deal. Chicago PMI, ISM reports. These are all possibly a problem. Factory orders. Productivity was fantastic last time. If it wasn't for productivity, I think everybody would be in a much worse mood. So if productivity stays up, if unit labor costs keep going down, that would be great. That's going to be a very key report next week. Consumer credit, we need to watch carefully. Non-farm payrolls, nah, nobody really cares anymore. Consumer sentiment, though, very important. Then we've got CPI, PPI, always inflation watch things. God, what is with this person? I gotta get this app off my thing. Then we've got retail sales. We'll see how that went for the Black Friday report, basically. Empire State Manufacturing is a constant disaster, so I don't see what the point is. Industrial utilization, industrial production, and then finally, housing information. Housing, this is a boring week. And then another estimate of the GDP, which isn't going to change probably at that point, not much. Leading indicators. Durable goods, we know are not very good. Anyway, all right, so there's nothing jumping out at me. I'm like, oh, that's going to be a big bullish thing. You know, that unless productivity is going to be the key. So where did we say that was? Not there. So next week. Non-farm payrolls, productivity, next Wednesday, I guess. This is the most important report right there. Next Wednesday, productivity is a key to everything. If it maintains this 4.7, which is a crazy number, the quarter-over-quarter productivity, right? It went from negative in Q1, it went up to 3.6. And don't forget, this is pre-AI, right? And here's AI. And AI is getting put more into use, and we'll see if it continues. If this trend continues, this could save everything. If this turns out to be a bit of a blip, that's a whole different problem. So we are going to see what comes in for the next report. That's going to be, I can't imagine anything more important that's going to be in the economy right now. Because if your productivity is up like this, then you're beating inflation, right? You're keeping up with inflation. The companies can handle, they're reducing their labor costs and they are increasing productivity. That keeps the inflation under control. If you don't have that and we still have inflation, then the Fed is bound to act. They have no choice. And and the Fed next week, the Fed's meeting next Wednesday. So very, very interesting. We have a lot of stuff to talk about next week. And like I said, tomorrow, let's go over our final 5 trades of the year and we'll figure out a winner. And that'll be good. So very, very big thing next week. Huge thing. The Fed meeting is going to be on Wednesday. So we're going to have that to talk about. We'll talk about the final trade of the year and how we ended up there. And we will also see how this is all playing out because we'll have gotten the productivity report by then. So lots to look forward to. All right, it's going to be very interesting. But like I said, hedging. Okay, that's what we did today. I got the colors working again in chat, although I have to do it manually, but it's still better than nothing. And there it is. I'm amending yesterday's STP move. We bought back 100 of the 202625 calls. And that tilts us it's a simple adjustment. It tilts us much more bearish, and we're prepared for a pullback now. And I feel much better about that because we have huge gains in the portfolios. So why wouldn't we want to lock them in? You know, as a rule of thumb, you want to spend about 25 to 35% of what you gain should be put back into your hedges, and that's what we did. We had well over $100,000 in gains, and we only spent $30,000, $40,000 in hedges. And it makes sense, right? Your market goes up, you make money on your longs, you do more hedging. You take some of that money and put it into more hedges. It's a very simple process. All right, thank you everybody for coming. I appreciate it, and we'll do it again next week. All right, take care.